10 years ago, earning $100,000 a year meant you'd made it. Today, there are people earning that exact amount refreshing their banking app before payday. How does a six-figure income turn into financial anxiety? Let's walk through a very normal, very real scenario. Imagine someone living in Chicago, London, or Toronto. Mid-30s, corporate job, stable career path, responsible, educated. They earn $100,000 a year. On paper, that sounds comfortable, but after federal, state, and payroll taxes in the US, or income tax and national insurance in the UK, or combined federal and provincial taxes in Canada, that $100,000 often becomes something closer to $65,000 to $72,000 take home. Let's call it $70,000 to keep the math simple. That's about $5,800 per month deposited into the bank account. Now the real world begins. Rent or mortgage in a major city, $2,000 to $2,800. Let's say $2,400. Car payment, $450. Insurance and fuel, another $250. Student loans, $400. Health insurance or private coverage contributions, $300. Utilities, internet, phone, $350. Groceries, $600. Subscriptions, gym, small conveniences, $200. We haven't added vacations, we haven't added unexpected medical bills, we haven't added helping family, we haven't added investing seriously, and already we're around $4,950 to $5,200 per month. That leaves maybe $600 to $800 on a $100,000 salary. Now add one wedding trip to Spain, one car repair, one higher than expected energy bill, 1 month of emotional spending because work was exhausting. Suddenly, that leftover margin disappears. So technically, this person isn't poor, but psychologically they feel fragile. And that's the real issue. The hidden mistake isn't overspending in an extreme way. It's building a life that expands perfectly to match income. Most people don't dramatically overspend. They proportionately upgrade. Better apartment, newer car, nicer neighborhood, more dinners out, more I work hard, I deserve this. The problem isn't irresponsibility, it's alignment. Their fixed costs rise to meet their new identity. When someone earns $55,000, they behave like someone trying to reach six figures. When they reach six figures, they behave like someone trying to look established. This is lifestyle inflation, but not the dramatic version you see on social media. It's subtle, logical, defensible. The $450 car payment doesn't feel reckless. The nicer apartment feels safer. The international trip feels culturally enriching. Individually, each decision makes sense. Together, they create pressure. Here's the quiet math most people don't calculate. If that person invested just $1,000 per month from age 30 to 45, assuming a conservative 7% return, they'd accumulate roughly $315,000. If they waited until 45 to start because they felt tight in their 30s, they'd need nearly double the monthly investment to catch up. The cost isn't visible today. It's invisible future optionality. And psychologically, humans discount the future heavily. Behavioral economists call this present bias. We feel today's rent. We don't feel 2045. We feel today's car comfort. We don't feel compound growth. There's another layer. In the US and Europe, social comparison is constant. Colleagues upgrade homes. Friends finance Teslas. LinkedIn celebrates promotions. Instagram documents lifestyle upgrades. You don't compare income, you compare visible outcomes. And visible outcomes are usually financed. The system quietly encourages this. Low down payments, longer loan terms, affordable monthly installments. The monthly payment becomes the decision filter, not the total cost. A $45,000 car doesn't feel like $45,000. It feels like $529 per month. But $529 invested monthly for 15 years at 7% becomes over $160,000. That's the real trade. Most people aren't living paycheck to paycheck because they're irresponsible. They're living paycheck to paycheck because their fixed obligations are optimized for comfort, not resilience. Financially intelligent people think differently. They don't ask, can I afford the monthly payment? They ask, what does this remove from my future? They build margin on purpose. Their lifestyle lags behind their income, sometimes by years. From the outside, they look normal, maybe even average. But internally, they're buying flexibility, the ability to leave a toxic job, the ability to take a sabbatical, the ability to invest aggressively during downturns. They don't avoid nice things. They just delay permanent cost increases, because permanent costs create permanent pressure. If you earn $100,000 and feel stretched, it doesn't mean you failed. It likely means your financial structure is fragile, and fragility feels like stress, even at high income. The uncomfortable truth is this. $100,000 isn't low income, but in major Western cities, it's no longer a wealth-building guarantee either. Income creates opportunity. Structure determines outcome. If your fixed expenses consume nearly all your take-home pay, you don't have a high-income life. You have a high-expense life, and those are very different things. This isn't about cutting coffee. It's not about extreme frugality. It's about understanding that wealth isn't built at the edge of your income. It's built in the gap. Close the gap and the stress grows. Protect the gap, and over time, the pressure fades.